National Insurance Clearinghouse, the marketing arm of Brokers Alliance, presents a Bravo video event, the Business Insurance Zone, dedicated to financial professionals who use insurance in their practice.
And on today's show, business succession planning with industry consultant Ken Davis.
And now the host of the Business Insurance Zone, the whiz of the biz, insurance columnist Steve Savant.
Well, welcome everyone to the Business Insurance Zone. I'm Steve Savant, your host, and we're broadcasting live to a nationwide audience of financial professionals right here in Fountain Hills, Arizona, home of America's largest fountain. And with me today, Day 5, Ken Davis, CLU, CHFC, CFP, and CPA, and my personal friend, and been in our kind of off and on study group for about, what, almost a quarter of a century.
Hey, Stephen. Good to see you.
And we, by the way, a lot of people don't know this little trivia about Ken and I. We also hosted for Allstate, the Good Hands people were our sponsor. They paid us to do the crazy stuff we do. We used to have our own radio show every Saturday. Was it an hour? I think it was an hour show, something like that. And they paid us to do that. It was great. I mean, I love that. And we're not doing radio because that's like a confining audience now. We're worldwide. In fact, just a little side note. I know, Ken, you'll find this cool. But I was doing my Google Analytics and my YouTube and Vimeo Analytics on the show, and about 6% of our total clicks are from outside the United States, of which Germany is our lead country, right?
Wow.
Well, Deutschland über alles. I mean, I was like, oh my gosh, we're hot in Berlin, right? You know, I mean, I'm looking at this. This is the internet, though. Think about it.
It's everywhere.
I mean, we're everywhere. Now, of course, I usually caveat the show by saying the strategies and tactics on this show before going forward, don't forget to check with your CPA. Listen, if you're in Germany, your code isn't anywhere near our code, so you really better check with your people.
Well, and as long as we're sharing, personal stories, when you were with Allstate in California, speaking up and down the coast, you had that, I'll never forget, you had that one guy approach you and said, Steve, this is great, but it's like an hour and a half to drive here. It's, a couple hours during the information and then lunch and then another couple hours back to the office. And my day's shot. Don't you have any of this recorded?
Right.
And that was before the whole internet thing and all that stuff taken off. And he said, well, gosh, we did these radio shows. Could I burn you a disc? And we had like 13 different shows.
It was great.
So you burned one for him and he calls you and said, God, this is great. Could you have any more? Well, then you took that, and I remember you had your child was reproducing these CDs, and you were selling them up and down the coast at $5
I was in shock. I couldn't believe it. The thing about it is, if you take our show, you can dump this down to your MP3 or 4 player, depending upon how blessed you are technology-wise. You can push it on your PC, put it in recording, put it on your smartphone, because I got guys that actually listen to it on the way in. Please do me a favor. As entertaining as I want to be, please do not drive and watch the actual video. I have a guy that called me and says, Steve, I ran into a curb. I was hysterically listening to your show. So please, no texting. No texting. No watching the video portion of the show while you're driving. I'm sorry to say it. Well, now we're in day 5, and we're going to walk into Ken's wheelhouse on business succession planning, taxation. Now, I know a couple days ago we get people calling me up saying, wait a minute, time out, Steve. Life insurance could be, in a C corporation in certain circumstances, be treated as a preference item under the code, i.e. the alternative minimum tax comes online. That freaked out a lot of our listeners, I have to say.
Well, I'll refer them back to the kit that they can just have for free simply by calling in. And the report and all the stuff seems really technical and kind of crazy and out there.
It's not that bad.
It's not. And if you get the report, it's written actually for our own clients, let alone agents. So it is digestible, and it's a relatively small problem. Number one, most people don't do C-Corps anymore, but if they do, more often than not, they're not large enough, they're going to run into this problem. But once they hit certain statistical thresholds, and that's all in the report, tells you the details of what those are and what to look for. Then the receipt of life insurance proceeds into the company. This is where the company buys the life policy. It's a C corporation, and they're going to purchase the shares from one of the partners that passes away. Well, normally, as we know, life insurance proceeds are tax-free, with only a couple of exceptions to that rule. And in this particular case, it can create a tax preference item. And for those that don't know what AMT is, alternative minimum tax. It's another way to compute what the taxation on a C corporation should be. Because remember, a C Corp is a taxable entity. Okay, so there's the regular calculation of taxable income and taxes, and then there's the supplemental, and you essentially pay the higher of the two. Well, what AMT does is it takes your taxable income and adds back in tax preference items. And one of them could be, frequently not, but could be, the difference between what's reported as taxable income, which is 0, and what generally accepted accounting principles says, which says you actually receive that cash, and so those are earnings. And the differences can be treated as a tax preference item. And could actually cause additional tax. So that's where AMT comes from, and so that's that situation.
We had that. If you want to see that calculation, if you have some company that's a pretty large company, C-Corp, we'll send it to you. Maybe they may have insurance that the company owns, and they're not even aware of this.
Well, and the other thing I didn't really talk a whole lot about, the other way that you turn proceeds in, and some of us have become aware of it because of the life settlements, but when you transfer ownership of a policy to somebody who isn't the insured. So if a partner transfers a policy, well, say I owned a policy on you, and we had Sally as our third partner, and if I transfer the policy, my ownership because I die, then goes to Sally, she's not the insured. And in a C-Corp situation, that's a transfer for value. There are plenty of exceptions to the rule, but suddenly the death proceeds become fully taxable in excess of the basis that you have.
Well, we're just talking about all these things in the light of business succession planning. I like this back a couple days back, and we took some email on this as well. We're talking about basis. Now, on one entity purchase versus cross purchase, there's two different treatments of this. One, there's a step up in basis. We love that. There's another one where we didn't. I want you to make sure that we understand that, because that actually drew some flies on a couple shows back.
Okay. Well, let's make sure our listeners understand the two different types of purchases. There's a situation where the company buys the life policy, receives the proceeds, and then purchases the shares from the deceased partner's estate. In that situation, there's no step up in basis. Okay. The entity bought it, not another person, and so it doesn't matter that the deceased's estate has a step up in basis, because the company doesn't get that, right? On the other hand, if it's a cross purchase where partner A buys a policy on partner B buys a policy on partner A, that's the cross purchase. So B dies, A gets the proceeds. He gets it tax-free. There's no AMT issue with the individual. Okay, so that's preferable. And then B's estate has that stock in it because it's part of the estate, whether there's estate taxes paid or not. If it's too small, there won't be. But he gets, the estate gets a full step up in basis for income tax purposes. Okay, so this is how it flows. The money goes to A. A then purchases the share from B's estate. The cash goes to the estate, the shares goes back to A, and now A owns it all. Well, B got cash of $1 million. That's a sale. Isn't that a taxable event? Well, normally sales of stock are a taxable event. What is the tax basis to calculate the income taxes on that sale? Simple. It's $1 million, even though initially they might have put $5,000 to get the company started and only had tax basis during life of $5,000. Because of the estate tax rules, full step up in basis to $1 million. So if they sell it for $1 million, tax-free death benefits on a life policy, tax-free sale of exchange for income tax purposes could be subjected to estate taxes. Now, let's clarify just a little further. Let's say that they held on to it for some time and there was some huge event that popped the value of those shares up to $1,200,000 by the time it actually transferred. And in fact, there was some sort of an agreement that they would pay the $1 million to. It was $1 million on the day of death, and now it's worth $1.2 million, and that's sold. There would be a $200,000 gain, but not $1.2 million.
Well, these points are huge, because step up in basis, when one could be, that's another consideration. Sometimes I think, I'm just doing the entity, just be done with it. Buy, sell, sounds so simple. And I go, well, wait a minute, time out. It is simple, and it is the easiest to adopt. but there may be tax ramifications, the biggest one being step up in basis or the lack thereof, and that's an issue. And so when you're looking, well, Steve, I don't know which one to do. Well, that's why you can call us here at Brokers Alliance. I have this whole turnkey business succession. It's a complete document. It's an anthology, and you can get it. And again, remember, you can always call Ken, 1-800-290-7226. I set up a separate line for him when he's in here. He's not a W-2 employee of ours. He's a consultant. He does a lot of work with all our producers. His extension is 117, and just go ahead and leave him a message. He'll walk you through some of this, and believe you me, you'll want him to do that. Now, Ken, one thing that when we talk about taxation, when we talk about EMT, well, they say, well, how many companies are C-Corp and are making all that money? Yeah, that's not that big a deal.
No.
Hey, this is a little bit bigger deal. This whole thing of step up in basis, that is a big deal.
Yes,
I get that. And I really like yesterday's show. We talked about wait and see trust because I like the idea of say, well, I don't know what we want to do. Company says, well, we don't want to take the option on the first, because the wait and see trust allows you to take an option on this. The company's first, shareholders second, but if either one of them don't do it, then it reverts back to the company and they have to buy it at whatever prescribed price.
Right.
Okay. I always try to think about this because when we do estate planning, I see so many companies or so many estates that the majority of the estate is the business. That's the majority of the estate.
Right.
So when we're talking about estate planning, I always look at estate equalization because not all the kids are generally involved in the business. I'm trying to make things fair, equal as much as I can. But at the front end, when I'm doing a buy-sell arrangement or a cross-purchase or a stock redemption or a wait-and-see trust, I have to start thinking in the back of my head, there might be estate planning ramifications. As I confessed in Monday's show, I usually departmentalize everything. This is estate planning, this is business succession, this is charitable giving, this is retirement modeling. But sometimes this stuff is so integrated. When I'm talking about business succession planning, what about estate issues that I have to think about, especially when the estate, the bulk of the estate is the actual business?
Well, and before I get into that, just realize you and I have both been using the term wait-and-see trust. It's really a wait-and-see buy-sell agreement, so I just wanted to clarify that so we didn't confuse our listeners. But anyway, in an estate planning situation, of course, we've talked about the income tax aspects of it, but there is also estate planning aspects of it. And there's a couple of things that can be done from an estate planning standpoint is, let's say that you have Harry, who's the son, who's involved in the business.
Well,
and I know it sounds like we're going to have to wrap up here.
No, we'll keep going on this, but I'm just thinking when you talk about stories, and I want you to hold your story till the second part, because this is what I want to make a point on. Storytelling, not so much raw data, but Sally's married to Johnny. Johnny has a partner named Jimmy. They own a business. Sometimes allegories or storytelling is better on your first interview than to be talking about the raw data of buy-sell agreements and things like this. You're listening to the Business Insurance Zone. Right here, you can write us anytime, thebiz@brokersalliance.com, or call us toll free, 1-800-290-7226, extension 147, for any of your questions on business succession planning. Ken and I will be right back after a word from our sponsor, Brokers Alliance, one of the largest distributors of life insurance to professionals in the country.
Whether you're a professional planner pursuing a strategic partner or an insurance distributor seeking a national alliance, your business just went into overdrive. Now enter the largest resource of insurance products and services with unparalleled access to a worldwide audience of consumers through the National Insurance Clearinghouse, the marketing arm of Brokers Alliance, who can take your company and launch it into the stratosphere of success. With countermeasures, the most comprehensive carrier intel in the industry, the MASH unit with field triage underwriting and the premium tolerance test, the life insurance financial evaluation, the most rigorous policy review, and Bravo high-definition broadcasting with online social media. Your search just ended.
Well, welcome back to the Business Insurance Zone. I'm Steve Savant, your host and national insurance columnist. Oh, I just did that national in there. Financial color commentator and interviewer.
International.
Yeah, it's Germany. I can't believe it. Before moving forward with any of our strategies that we talk on this show, always check in with your CPA, your tax attorney, and if you're FINRA licensed, your broker-dealer department. And, compliance department. Yeah, not any department, your compliance department. Hey, you can call us for any I know. You can call us for any quotes or questions on any of the products that we sell at 1-800-290-7226, extension 147. It's not what I know, it's who I know, and that's why I have the premier guests in the country on this show. And today, of course, Ken Davis, CLU, CHFC, CFP, and CPA. Man. I feel like I should start buying cereal for Ken. Remember that old alphabet cereal that you could pour? Ken was going to start a story, and I had to stop because we were heading to break. But telling stories is a great way to sell. Ken, tell that story though, because it's a great story.
Well, and let me just set up the story. I mean, one of the things is family dynamics. When you're doing buy-sell agreement, there's lots of stakeholders, and we haven't talked about this in the other shows. There's also employees. There's key employees that have helped build the business, and maybe they should be involved in buy-sell agreements and stuff, and buying insurance. And then there's that, the typical family where there's like 3 kids. There's Jeff and Harry and Mary, right? So Jeff's the one who got involved in the business, and Harry and Mary say, no, I'm going to be an artist, and he's going to be an attorney, and Jeff's the only one there. Well, Dad knows that Jeff's important to the business and building it up. And also, Jeff is looking, saying, I'm adding all this value, and I'm going to have to purchase this company at a much higher price later on. So one of the things they do in estate planning is what they call an estate freeze. Get assets passed from the owner to the children so that any future growth doesn't create more of an estate tax problem. So say you have a $10 million estate already, and the business has the ability to add another $5 or $10 or $20 million to the estate. Well, that just becomes that much bigger an estate tax problem. So maybe transferring shares, purchasing shares during life, or with this $5 million gift tax exclusion.
So I just want to make sure I understand. So in business succession planning, I may have to also think about the long-term ramifications, and I might be able to deal with that while I'm doing the regular buyout.
That's right.
Wow.
You start doing estate planning where you're starting to pass shares to the next generation now, and there's other issues. Maybe Jeff, the son, buys life insurance on Dad and has the money and has the buy-sell. Well, Harry and Mary can't complain because, Jeff bought out Dad's estate for the full value that was negotiated at the original price. Or maybe, like I said, you can have a estate tax freeze or actually purchase the shares in today's value, not the future value. So there's the family dynamics of, and this is typical, the dad or the mother who owns the business has a key employees that happens to be their child. They see the value that child brought to the table, and they want to take care of them and reward them for that. But at the same time, they don't want the other 2 children to feel left out. So typically, in a more traditional family setting where the man is the primary breadwinner, Dad wants to take care of the kid, and then Mom goes, well, yeah, but we got to take care of the other 2 children. Want to hurt their feelings? Okay. So there's those issues too. In estate planning is making choices up front of who's going to get what, when they're going to get it, what the prices are, and looking at income taxes and estate taxes. So it's a very holistic type of an approach.
When I think of family-owned businesses, because you're hitting it right on the head now, family-owned businesses are the bulk of America. These are just a big number. And we have scenarios like this all the time that not all siblings are involved. And I can tell you right now, and one of the early on estate plans that I got involved in as a young agent in my early 40s, this is some time ago, we sat in front of a person. At that time, they had 20 million. That's a pretty good sizable state back then. Yeah. 20 million, and there was only 2 things that client wanted us to hear. The male component wanted us to hear, how will we defeat estate taxes in every way possible under the code legally? The mother wanted to hear, how can I pass my estate on to my children equally, unless there's a bad seed, of course.
Which we call equalizing the estate.
Now, the reason I bring this up is because I don't want to be in a situation where I have this huge business and it's so big part of the estate. How can I go ahead and carve that out? And I don't want to wait. I love freezing because I don't want to take this to the time of transfer. I want to cut this off at its knees way up front while I'm doing my business buy and sell agreements. Now, the reason I like this is because this is a sale that normally is never attached to each other. So it has a secondary sale. You get done with the buy-sell agreement. Maybe you're taking care of the key man like we talked about Tuesday. But now we're adding another thing to play. Well, this is a pretty sizable estate, and most of the estate is this business. let's go ahead and freeze this now, take care of the equalization issues now. Let's pass on everything. Let's move as much as we can so that we don't have a huge estate tax and we settle the distribution of who's going to get what way up front.
And I know that our agents are great salespeople and they're going to be hip to this. If we throw all of this at the client all at the same time, they're going to freeze. They're going to go, oh my God, this is way too big of an elephant. So I forget what that book was, but How to Eat an Elephant One Bite at a Time. So you present it one bite at a time. You start with a cheap, inexpensive, put your buy-sell agreement in place and do some term insurance and get started. And oh, by the way, we need to do some disability. And then you start getting involved and say, well, you know, while we're doing this, we should, and you're into it, you're building this relationship, you've gotten their attention, you've gotten the thing started, so the momentum's on your side, and now you can go back and say, you know, we really need to be looking at the estate aspects of this as well. And what you do is kind of think about it and just kind of slide it in piece by piece till you've built the whole plan. If you try to chew it up, you know, take care of it all at the same time, it gets a bit overwhelming. So I have to be careful. We may go, wow, I feel so good. Look at all the cool things I know, and I'm going to just blurt all this stuff out. Well, obviously, that isn't going to work. So you make sure you start with the easy stuff, ask those questions, get them thinking about the business, thinking about the family, the key employees, all these dynamics, and how many people depend on these decisions. And usually these guys that own businesses do care about people, and that's why they've been successful. So they're going to get this.
When I think about setting up my business succession plan with my partners, I'm there now, and I've chosen which entity, you know, I'm going to be in. And I might have to reconfigure my entity to make this all work. I mean, I've seen some companies
add an additional
one. So I see that, and then I'm going to have to look at buy, sell, or maybe cross purchase, wait and see, stock redemption. There's a lot of options here. I want to be able to see if I can cover off. And the new one to me, I have to say, is key person. And I always thought that's the employer's key guy is Rainmaker. But Ken, you're saying no, the key guy is the guys who own it.
Well, that's right. I mean, the buy-sell goes perfectly. The insurance is in place and everything else. But now the surviving partner sitting there going, oh my gosh, I depended on Susie she's a great salesperson. She'd take them out to the ball game. She'd have lunch with them. She knows all these people personally. She's kind of like the godfather. She's got all these personal relationships. When she's gone, those relationships die with her. So what do I do? You know, where's the money going to come from? And the bankers look and say, you owe us this loan, and your sales revenue is going down, and you know, what are you going to do? Well, if you had the the key man insurance on Susie for that $500,000, $2 million, that gives you a financial bridge to the future.
Now, oddly enough, not that I'm getting into, I don't want to get into life settlements here, but I just came across a case a couple days ago. A producer brought it, says, Steve, we're going to unwind this buy-sell agreement. We don't need anything anymore, but I'm looking at the cash value of the retirement plan. I said, oh, that's great, no problem. I said, what else you got here? I noticed you had a few other policies listed. He goes, I have several term policies listed. And I said, well, I'm wondering if they're under the convertibility clause. I mean, if they still have convertibility. We checked with the vendor, the carrier, and they were still convertible. I said, but you're not going to need this anymore. This was written 7, 8 years ago. Ken, talk about bringing cash to the table immediately. We're selling, and I can't believe this. The one was, I'd say, I had a 70-year-old and a 63-year-old. We sold their term policies as a settlement issue. They were both convertible because the time of the partnership has terminated. But these policies are still out there. Talk about just a little bit. I know you don't know, you're not into life settlements per se, but what a great idea.
Well, what people assume that term insurance has no cash value. But if you have a term policy on somebody that's been sick, they've had a heart attack, they've had cancer, whatever, still, you know, they recovered, you know, and in remission, stuff like that. But the statistics show that they're much higher risk and may very well not be able to get new policies. But if they get a term policy that's convertible, then they have the right to convert. And so they can go out and shop the market to see. I mean, say the guy's 65 years old, he's got a life expectancy of 6 years now based on the situation. That potentially is saleable. And you know, say it's a $5 million buy-sell agreement policy. He thinks he's just going to let it lapse and drop. I actually heard a story by a company that said they had, I think, an $8 million term policy that they actually were able to get $2.7 million worth of cash value because they converted the term into a permanent policy at the original preferred rating, and now the investor can come in and buy that even though they have maybe a 6-year life expectancy. That's crazy.
And they were going to lapse it.
They're going to let it go.
For nothing.
They're throwing the thing in the trash.
Yeah,
it's like a lottery ticket worth $2.7 million in the trash can.
And it's not that I want to institute life settlements on older geriatric and or substandard clients inside a buy-sell agreement, but I think you got to look at this because 3 or 4 cases that we've touched have actually brought serious money back into the corp on a policy that they were just going to throw away anyways. So
and they may just choose to convert it and keep it because if it's valuable to the investors, it's certainly invaluable to them.
And I saw some serious numbers. I mean, the number you just said is a big number. What was the face amount again?
It's like $8 million.
And what did they get for cash?
2.7 or something like that.
They got $2 million for an $8 policy that they were going to drop. I mean, that's cha-ching right to the business.
It's so crazy.
Unbelievable. Well, these are the things we're talking about all this week on business succession planning. You can watch this entire series out on our Vimeo site, YouTube, or just go to Brokers Alliance, www.brokersalliance.com. As soon as you come to our homepage, you'll just see the big red button. It says on-demand video. Just click on it. Not only these shows, but all our shows. And by the way, think about this. We've been broadcasting for a little over a year. We got about 200 episodes out there. We are sick people. We're delivering information on demand via the internet. Unbelievable. Well, again, all our shows are in beautiful HD 1080p, all on our homepage, www.brokersalliance.com. Just come to the page and click on the red archive button. On demand, you'll be right in there. And of course, all our links are all over our social networks, YouTube, Vimeo, Facebook, LinkedIn, and of course where I tweet, Twitter. This is Steve Savant for Ken Davis. You've been listening to the Business Insurance Zone. That's the buzz on the biz for today. Get in the zone, the Business Insurance Zone.
This has been a Bravo video event of the National Insurance Clearinghouse, the marketing arm of Brokers Alliance, one of the largest distributors of insurance products and services to a nationwide network of insurance professionals. Need insurance guidance? Call Brokers Alliance. Business Insurance Zone, dedicated to financial professionals who use insurance in their practice.